In this video, we're going to take a look at IWMY, which is the R2000 Enhanced Options Income ETF. It's a popular income-focused ETF because of that insanely high yield that you can see to the right. As of August 30th, this fund currently advertises a dividend yield of 110.96%. And what's even crazier is that this yield has been growing over time. In other words, it's claiming that you'll basically make back your original investment in the form of dividends in less than a year. And then on top of that, it also pays monthly dividends, which is especially appealing for income-focused investors who might be looking for income in retirement or even those trying to retire early off of dividends. So let's take a closer look at this ETF and see if there's something worth investing in, either for a large position or perhaps a smaller, more speculative part of an income portfolio. According to its website, it says IWMY aims to achieve consistent monthly yield distributions for investors coupled with equity market exposure to the Russell 2000. IWMY is an actively managed exchange-traded fund that seeks enhanced income constructed of treasuries and Russell 2000 index options. The strategy's objective is to generate monthly distributions by selling option premiums on a daily basis. The fund uses daily options to realize rapid time decay by selling in-the-money puts. The fund's primary investment objective is to seek current income. The fund's secondary objective is to seek exposure to the performance of the Russell 2000 index, subject to a limit on potential investment gains. If we take a look at this ETF's performance, we can see it's provided a total return of 13.74% since this fund's inception from a share price perspective. Using the dividend reinvestment calculator that I like to normally use, it's saying its total return is 15.49%, so I'm not sure which is correct here. Keep in mind though that this ETF was launched less than a year ago, in October of 2023. So there's two things that really stand out about this. A total return of 13.74% or 15.49% for less than 1 year is a pretty good return. An average year in the S&P 500 returns normally between 9 and 10%, so IWMY is doing better so far on average. But another intriguing thing is that dividend yield. If this ETF yields over 100% but it only returned 13.74% up to this point, what exactly has been happening to the share price of this fund? Defiance doesn't provide a price performance chart on their website for their ETFs, which is probably intentional once we look at how IWMY's done in the market so far. Since its launch, it's already down roughly 41% in share price. On top of that, it's already performed a stock split back in July. It looks like they did a 1-for-3 split already, and it's down quite a bit since then. You can see it also has this very peculiar pattern of consistently dropping at certain times and then usually building itself back up a little bit before dropping even further. The reason it does this has to do with the main strategy of IWMY, which we'll now take a look at. Judging by the unusually high yield of this fund, you'd probably guess this ETF uses options to a certain degree in order to achieve its insanely high yield, and you'd be right. It doesn't use a traditional covered call strategy like what you'd see from QYLD or one of those kind of funds. This is a put-right fund, which is when a fund sells puts on an index. In this case, it sells puts on the Russell 2000 index, which is what's in the name of this fund. The puts that IWMY sells are pretty short-dated, and as a result of this strategy, it's why the share price looks like this. On the first day of every month, it does fall in share price, and then depending on the performance of the Russell 2000, it slowly starts to recover. But it obviously doesn't have enough time to fully recover before the next distribution happens. If we go back to this fund's description, it says its primary goal is to seek current income. Its second objective is to seek exposure to the performance of the Russell 2000 index, subject to a limit on potential investment gains. It doesn't say its goal is to achieve capital appreciation, like practically every other income-focused ETF or closed-end fund that I've come across. If we now look at the dividend history of this fund, we can see it hasn't gone down a whole lot since it launched. If you look at other ultra-high yielding ETFs, you almost always see a consistent trend of falling dividends over time. In the case of most yield-max funds like Tesla, it's been seeing decreased dividends as time goes on. With the exception of IWMY's most recent month, it has been trending down slightly over time, and so far, Seeking Alpha is showing that their dividend yield has actually been increasing. But I would chalk this up to a higher amount of volatility in the Russell 2000 index, so this isn't going to be a trend that lasts forever. Their most recent dividend was for $3.67 per share, and this ETF is currently trading around $36.50. That's an insane amount of income for this fund, and it's no wonder why it draws people to it. Going down to the holdings section on this fund's page, you'll see it lists treasury bonds as being in its portfolio. This is the case with a lot of options-based ETFs like SVOL and JEPY. A lot of them use treasuries as a form of collateral for their option strategy, and since they're offering a higher yield than average still, it does provide a little bit of benefit. But obviously, since it's yielding 110%, those treasury bonds that are yielding a little over 4% aren't having too much of an impact. But the Russell 2000 is what it does its option strategy on. It's a small cap US stock market index that makes up the smallest 2,000 stocks in the Russell Index. There exists a regular ETF of this index, which is the iShares Russell 2000 ETF, ticker IVM. It's a pretty well-diversified index, and it doesn't heavily lean towards tech. It's got a good mixture of healthcare, real estate, financials, and industrials among many others. When it comes to stock indexes, the Russell 2000 has been a lackluster performer compared to the S&P 500 and the Nasdaq 100. In the last 5 years, the index is only up about 41% in share price. If we compare it to the other two indexes, you can see the S&P 500 has done more than twice as good as the Russell, and the Nasdaq 100 has done more than 3 times as well over the last 5 years. Because these options-based ETFs have limited upside capture, we've seen pretty much all of these Russell 2000 ETFs struggle when it comes to share price appreciation. Small cap stocks are considered riskier and more volatile investments than larger cap stocks. A small cap stock is a company whose market capitalization is between $250 and $2 billion. These companies can potentially have better growth prospects, but they've been underperforming for some time, likely being overshadowed by tech for a while. Small cap companies also face greater risks in the event of a recession because they aren't as well established as companies like Amazon or Google. This index just hasn't been a great index for structuring an options-based ETF around. A good example of this would be RYLD, which has been underperforming as well. It does use a different strategy, I get that, but RYLD captures more upside than IWMY, and even this ETF hasn't done well with growth. The company that launched this ETF, Defiance, also has these other funds that follow a similar strategy to this one. One of those would include JEPY, which follows a similar put-right strategy, only on the S&P 500. It does offer a lower yield but less share price depreciation. Then there's also QQQY, which is just like JEPY and IWMY, only it uses the Nasdaq 100 index. I actually went in depth on this ETF about 3 months ago if you want to check out that video. It offers a pretty similar dividend yield and monthly payments, but then again it also suffers from this consistent fall in share price over time. Let me know if you want me to go in depth on some of these other funds in the comments below. Defiance also has some of these other ETFs with different strategies, including SPYT and QQQT. So what are we to make of IWMY? The most concerning thing in my opinion has to be that share price erosion. The fact that this ETF in less than 1 year after being launched has already performed a reverse stock split shows that capital erosion is a serious issue. But what about that dividend, which has remained pretty consistent up to this point, and the fact that its total return has been really good? For someone who's retired and wants high monthly income and not to reinvest the dividends, then recommending this ETF would be difficult. If the Russell 2000 were to start performing much better, then obviously this ETF would see better returns. But again, with that share price erosion, you just run the risk of losing a significant amount of your capital. It reminds me of the closed-end fund CLM. It does provide a really high yield despite the consistent share price declines and dividend cuts, but reinvesting the dividends can lead to a capital gain. But because of the cuts, it's not ideal for retirement income. In this case, my opinion is that it's just too risky to bet on if you need the dividends to fund your life expenses. If you do intend to reinvest all the dividends, then IWMY has proven to be a profitable investment for that purpose. And with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.